Welcome back to the Deep Dive. It's Monday, February 2nd, 2026. Today, we are opening up the books on a ticker that might not be on your daily screen, but maybe it should be, especially if you care about how geopolitics and interest rates, well, how they intersect. We are breaking down the tape on Central Pacific Financial Corp, ticker CPF.
It's great to be here. You know, usually when we talk regional banks, we're kind of bracing for impact. It's been a tough couple of years for the whole sector. Credit concerns, CRE blow-ups.
Margin compression.
Exactly. But CPF just dropped their Q4 2025 earnings. And honestly, it feels like reading a different book entirely.
It really does.
Yeah.
I was looking at the price action. The stock closed up, 1.5% at $32.18, but it tapped a 52-week high of $34.67 during the day before it cooled off. I mean, that doesn't scream recession fears.
No, it does not. And that intraday move is telling. It wasn't some low-volume spike. We saw active controlled buying. The market is clearly buying the story, the margin expansion story, and what did management call it? A cleaner core engine?
That's the phrase that stuck with me, cleaner core engine. Because you look at the headline numbers, they're good, but not, explosive. But you're saying there's something mechanical happening underneath all that.
Exactly. On the surface, it's a solid beat. But when you peel back the layers, you see they're fundamentally changing how the machine works. They're getting leaner, they're getting smarter with their cash, and they've put themselves in a really unique macroeconomic spot.
All right, let's unpack this then. We have a big EPS beat. We have an efficiency ratio that, and I know you're going to geek out on this, is finally looking elite. And a capital return story that just got a massive recharge.
Geek out is a fair assessment. There is one specific metric in this report that I think validates the entire bull case.
Okay. We'll get to your favorite metric. Let's start with the headlines, get everyone on the same page. GAAP EPS came in hot at $0.85 diluted.
Right, and the consensus on the street was sitting at $0.73.
So that's a 12-cent beat.
A 12-cent beat. For a regional bank, that's massive. That isn't a rounding error. That's real operational outperformance.
And the top line.
Total quarterly revenue hit $76.3 million. And get this, it's up 30.6% year over year.
Now, I have to play skeptic for a second. That year-over-year number, it looks huge.
Yeah.
But aren't we comparing against a really ugly Q4 24?
You are, and you have to be fair with the comps. Q4 of 24 had that large portfolio repositioning loss, so the bar was set incredibly low. It's an easy layup to look good against that.
Okay.
But, and this is the key, even if you strip out that easy comparison, the trajectory is real. Net income hit $22.9 million. That is a 101.6% increase over the $11.3 million from the year before.
So even with the easy comp, doubling your net income is, it's hard to argue with. Well, let's get at the metric you were teasing, the efficiency ratio.
This is the star of the show. It dropped to 59.88%.
Wow. They finally broke the 60 handle.
They did. And for anyone listening who doesn't spend their life staring at bank spreadsheets, let's just explain why the 60 handle is such a big deal. The efficiency ratio is basically a measure of overhead. It asks, how much does it cost this bank to generate $1 of revenue?
Right. So a ratio of 60% means for every dollar that comes in, 60 cents goes right back out, paying for the building, the tellers, the software.
Exactly. And in the banking world, 60% is sort of the holy grail line in the sand. If you're above it, you're seen as a bit bloated. If you're under it,
you're a high-performance lean machine.
And doing that in Hawaii, that's not easy.
Right. That's the context people miss. It's an incredibly high-cost environment. Everything is more expensive.
Labor, real estate, electricity. So for a mainland bank in, say, Ohio, to hit 59% is good. For a bank in Honolulu to hit 59.88%, that shows serious discipline. I mean, it was nearly 63% last quarter. That's a massive operational turnaround.
And it creates so much leverage. As revenue grows, more of it just drops straight to the bottom line. You see it in the profitability metrics, too. ROA at 1.25%, ROE at 15.41%.
And ROE return on equity over 15% is elite territory for a regional. It tells investors, we aren't just sitting on your money, we are compounding it at a 15% clip. That's how you get a premium valuation.
Okay, so the engine is running efficiently. Now let's look at the fuel, the margin story. Net interest income was $62.1 million, but the net interest margin, the NIM, it expanded 7 basis points to 3.56%.
This is where the story gets a little technical, but it's incredibly important. Usually when a bank's margin goes up right now, it's because asset yields, the interest on their loans, are drifting up. But that wasn't the main driver here.
It was the other side of the balance sheet.
It was liability management. The CFO, Dana Matsumoto, she highlighted this, and I think it's the most impressive part of the quarter. The average rate on their total deposits, it actually fell.
Wait, it fell. In this environment,
Yeah.
everyone is fighting for deposits. I see ads for 5% savings accounts every day.
I know, and yet CPF's cost of deposits dropped to 0.94%, down 8 basis points. While the rest of the industry is in a knife fight for funding, they're somehow paying less for their cash.
How is that even possible? Are their customers just lazy?
It's a mix of loyalty and structure. They're managing what's called a deposit beta of roughly 30% for the cycle.
Okay, let's pause and define that. Deposit beta.
Sure, so deposit beta measures how sensitive a bank's deposit costs are to the Fed's interest rate changes. If the Fed hikes rates by 1% and a bank raises its savings rate by 1%, that's 100% beta. But if the bank only raises its rate by, say, 0.30%, that's a 30% beta.
So a low beta is good for the bank. The Fed rate goes up, but the bank doesn't have to pass all that extra cash to its customers. They keep the spread.
Precisely. And a 30% beta is incredibly low. It means their customers are very sticky. They aren't chasing yield into treasuries. And management expects to hold this 25 to 30% range, even with a couple of rate cuts forecasted for 2026.
That is a huge competitive moat. If you can keep funding costs under 1% while lending out at 5 or 6%, the math just works.
And we saw that in the spread. Deposit costs dropped 8 BPs, but their loan yields only dipped 2 BPs. They captured 6 basis points of pure margin just by doing nothing, really, just keeping their customers happy.
Okay, but let's talk about the lending side, because the loan book actually shrank a little bit. Total loans were down $78 million quarter over quarter. Is that a red flag?
It looks like one, but you have to look at the mix. This is what we call pruning. They're seeing runoff in residential mortgages and consumer books, down about $190 million for the full year.
Which are lower yielding assets.
Right. Why would you hold a 3% mortgage on the books if you don't have to? So they're letting those run off and actively growing commercial mortgage and construction. That portfolio grew 10% year over year. They're swapping low yield paper for high yield paper.
But I have to push back here. The COO, David Morimoto, he said Q4 loan growth was flat because of delayed closings. We hear that on earnings calls all the time. Is that just corporate speak for the deals died?
It's a fair question, and usually my skepticism radar goes off when I hear delayed. But Morimoto was unusually specific. He didn't just say next year. He said several large construction and commercial deals pushed to the first half of 2026, specifically weighted toward Q2.
So he put a timestamp on it.
Exactly. When a C-suite exec tells Wall Street Q2, they're usually looking at a term sheet that's pretty much signed. If they don't deliver in Q2, then we have a credibility problem. But for now, the market starts to trust that this is a timing thing, not a demand cliff.
Okay, so the loans are shifting to commercial and construction. But usually when I hear growing construction loans, I start worrying about credit risk. That's usually the riskiest bucket in banking. So how's the credit quality?
Surprisingly boring, which is what you want to hear. The CRO, Ralph Misek, confirmed asset quality is stable. Non-performing assets are at 0.19% of total assets.
0.19% is practically zero.
It's near cycle lows. And net charge-offs were only 18 basis points annualized. Most of that was in the consumer book, which, again, they're shrinking anyway. So you have this Goldilocks scenario where they're shifting into higher yield loans, but the losses aren't ticking up.
Before we move to the macro picture, there was one weird line item in the income statement. BOI death benefits. They recognize $1.4 million. Can we explain what BOLI is? It sounds a little morbid.
It is a little morbid, but it's a standard banking tool. BOLI stands for Bank-Owned Life Insurance. Banks take out life insurance policies on their key employees. The bank pays the premiums, the bank is the beneficiary.
So if a banker passes away, the bank gets paid.
Correct. It's used as a tax-efficient way to offset the cost of employee benefits. So in Q4, unfortunately, they had claims that resulted in that $1.4 million payout.
Okay, so from an investor's perspective, we just need to treat that as a one-off.
Absolutely. You can't model that into your Q1 projections. You have to strip that out to get the true run rate of the business. It's a nice cash infusion, but it's not core banking.
Got it. Strip the BOLI. Now, let's zoom out. This is a regional bank, but the region is pretty unique. The CEO gave an update on the Hawaii economy. What's the vibe?
It's a tale of two economies, really. On one hand, you have tourism, which is, the lifeblood, and it's soft. Visitor counts are down, job growth is softer. If Hawaii was just a tourism economy, this would be a bearish report.
It was not just tourism.
No. And this is where the deep dive gets interesting. The other massive pillar of Hawaii's economy is the military.
Right. Pearl Harbor, Indo-Pacific Command, it's a fortress.
Exactly. And military spending acts as a counter-cyclical buffer. When the global economy slows down and tourists stop coming, the U.S. Navy doesn't stop. The DoD budget is sticky. It provides a floor for the local economy.
So even if the hotels are empty, the barracks are full.
Precisely. And CPF is leaning into that stability. But they're also doing something new I found fascinating, a new partnership with Korea Investment and Securities.
This felt like a really specific strategic pivot. What's the play here?
This is the real insight of the episode for me. They're positioning themselves as a bridge between Asian capital and U.S. assets.
Unpack that. Why Hawaii?
Well, think about the geography, the culture. Hawaii has a massive Korean diaspora, deep cultural ties to Seoul. If you're a wealthy South Korean investor, you are always looking for yield and U.S. dollar exposure. You want safety.
And you probably don't want to park your money in some regional bank in Nebraska you've never heard of.
Right. But you know Honolulu. You might own a condo there. It's closer to your time zone. And critically, it operates under the safety of U.S. banking law. So CPF is partnering with this Korean firm to funnel that deposit flow into Hawaii.
That's brilliant. It turns the bank into a geopolitical hedge.
It diversifies them away from being purely dependent on the island economy. If tourism from the mainland dries up, they have this spigot of capital flowing in from Korea. You can't replicate this strategy in Idaho.
So they have the military floor and the Asian capital upside. What are they doing with all the money they're making? Because they announced some big capital returns.
They did. Hiked the dividend 3.6% to $0.29 a share, which is nice. But the big story is the buybacks. They bought back almost 800,000 shares in 2025, and the board just reloaded the gun with a new $55 million authorization for 2026.
For a bank this size, $55 million is a serious chunk of change.
It is. And they can afford it. Their CET1 ratio, that's the core measure of capital strength, is at 12.7%. Rock solid. Plus, they paid down $55 million of debt back in November. So they paid down debt and still have the firepower to buy back stock.
That is the definition of a fortress balance sheet. They're doing it from cash flow.
Exactly. They have plenty of dry powder. So looking ahead to 2026, management gave guidance. What are they telling us to expect?
They're guiding for net interest income NII growth of 4 to 6%. In a falling rate environment, growing NII at all is impressive.
And on the expense side?
Expenses are expected to rise 2.5 to 3.5%, investing in sales tech, data platforms. But notice the GAAP revenue growing 4-6%, expenses growing 2-3%. That's positive operating leverage. Margins should keep expanding.
It sounds a bit conservative, honestly, especially if those delayed loans actually close in Q2.
I agree. If that Q2 loan volume hits and they keep deposit costs low, that 4-6% growth could easily turn into 7 or 8%. They've left themselves room to beat. All right, we've covered the numbers, the strategy, the geopolitics. Now it's time for our favorite segment.
This is not financial advice.
Exactly. We call this the trade idea. Imagine you're pitching a wild thesis to an investment committee. It has to be plausible based on the data, but it is absolutely not financial advice. What's the trade?
I call this one the Aloha Iron Dome arbitrage.
The Aloha Iron Dome. I love it already. Break it down.
Okay, look at the macro setup. We have global instability. Tensions in the Pacific are rising. What happens in that scenario? The U.S. government pours money into Hawaii, the unsinkable aircraft carrier.
So military spending goes up.
Right. At the same time, Asian capital gets nervous. It looks for a safe haven in U.S. dollars. Where does it go? The most culturally familiar, geographically close U.S. banking hub, Hawaii.
So CPF sits right in the middle of both of those flows.
Exactly. So the trade is, you go long CPF as a proxy for Pacific Rim geopolitical tension. You're betting the U.S. Navy and Korean investors have better credit quality than the average consumer.
Then what's the short side of that trade?
You short a basket of mainland regional banks. The ones heavily exposed to generic commercial real estate suburban office parks, strip malls in non-strategic areas, places with zero military value and no international capital flow.
So you're shorting a strip mall in the Midwest and going long the U.S. defense budget and Asian capital flight.
It's a geopolitical hedge masquerading as a bank trade. You're betting that in a chaotic world, money flows to safety, and Hawaii is a unique kind of safe harbor.
That is a compelling thesis. And the kicker is you get paid a rising dividend while you wait for it to play out.
Exactly. But again, and I cannot stress this enough, this is a narrative trade idea. Do your own diligence. Please do not go bet your mortgage on the Aloha Iron Dome.
Please don't. but it does highlight why this isn't just a boring regional bank story. It's a play on a specific microeconomy that's decoupled from the mainland.
That's the takeaway, resilience. While other banks are fighting credit fires, CPF is pruning its garden and building bridges to Korea.
So to wrap it up, CPF delivered a clean beat. The efficiency ratio is finally sub 60, they're buying back stock, and the market's responding.
The big question for 2026 is execution. We need to see those delayed loans close in Q2. If they do, this stock has legs. If they don't, we have to ask some hard questions about growth.
So keep an eye on that Q2 print. Thanks for listening to The Deep Dive. Keep your eyes on the tape.
See you next time.